secrets. My name is Michael Trumper. I'm one of the principals here at Intaver Institute and have been working on project risk analysis and management and software development for over 20 years. Before we start, I'd just like to go over how you can participate in the webinar. Just see a pane at the top right of your corner, which will allow you to select your audio and also interact during the webinar. If you haven't done so, I recommend you using the computer option as the audio quality tends to be better. Feel free to use the questions pane to ask questions during the webinar. Now we'll have a Q&A after the webinar is over, where we'll answer questions in regards specifically to the webinar. But if you do have some technical issues, we'll be monitoring the question pane, and if you do have some questions regarding some technical issues, we'll try and resolve them at that time. So in today's webinar, we're going a little bit off track on what we normally do. It's not going to be a demonstration of the software or any particular interfaces with it. What we're going to do is look at one is solving the issue about how to get to a point where you're producing high quality project risk analysis, or solving I call it the garbage in, garbage out problem. We're going to use the analogy of preparing and delivering a great meal, just sort of create a meme on this. That is the basis. So a great meal, and then it's the basis for a memorable night that you would have with friends and family. The idea came around when we were just starting out coming up to our Canadian Thanksgiving, which occurs earlier than in the US, about a month and a half or 5 weeks, 6, 7 weeks earlier, and how we were going to all get together and how we prepared our meals. We thought we'd take that same sort of approach and about how we create a great holiday for everyone and a meal, and we'll apply that to this question. So great meals require a time-tested recipe that, when prepared properly, provides a memorable experience. Like a great meal, there is a recipe for performing high-quality project risk analysis that leaves stakeholders satisfied and helps to ensure the successful delivery of your project. In today's webinar, we're going to be looking at the recipe for an integrated cost and schedule risk analysis. So one of the issues that we have to get is we have to have high quality ingredients, and in this case it's the data. And in my experience and colleagues, when running a schedule risk analysis, the most important ingredient is a high quality schedule. So in the past, I used to think, well, how are we going to get the risks, and how do we develop the risk register and the risk assessment and input some of the other data. But really what what I found over the years is the biggest hurdle to performing when people are just starting out on risk analysis, project risk analysis, schedule risk analysis, is having a high quality schedule. Can't emphasize that point enough. So it's like if you have a roast, if you start out with the cheapest cuts, the end product will reflect the poor quality of the foundation of a meal. A high quality schedule is one that updates correctly when changes or actuals are added to the schedule. What does this mean? This means minimal hard constraints. As soon as possible should be the default constraint. No dangling activities. With the exception of the first and last activities, all tasks should have a predecessor and a successor. And in addition, the use of lags or excessive float should be avoided, as this will dampen the impact of changes of changes during the iterations that were run during the simulation. Resource loading is recommended for time-dependent costs. We recommend at a minimum you run the DCMA 14-point schedule diagnostics every time you import a schedule into Risky Project or update it. High quality ingredients costs. Cost ingredients can be divided into two parts: time independent and time dependent. Time dependent costs will be calculated based on resource rates and allocation. So if you're running if you have resources, it's important that we have resources are allocated, units per activity, and they have rates, accurate rates associated with them. What we wanted to do is be able to find how costs are affected by the uh, schedule risk. Time independent costs are expenses such as insurance and materials that are not time dependent. They can be added as line item costs to activities, and they can have risk impacts, or they can have ranges of possible outcomes, so uncertainty, ranges of uncertainty on them. Here we get into the risks are often referred to as risk drivers or risk events that are found in the risk registers. They have a probability of occurring and impacts cost and or schedule. Risks can be managed by either reducing the probability that they will occur or the impacts that they have in your project objectives. Now, the best source of risk data is going to be found in the risk register of your previous projects. This provides historical support for the types of risks that can impact your project. If you have an archive of these registers, we recommend that you create a standard template of risks that include the probability that occurred in the past, the impacts that it had, preferably as a distribution, and the activity types that they occurred on. Historical data, just to make a point here, historical data is always going to be your best source of risks. There are other methods available for risk identification and assessments, but the quality will go down uh, as opposed to having these historical data. They can be subject matter experts, interviewing, and risk workshops. But the best quality data will always be what has occurred in the past during similar projects. One of the things that we do is we use the historical data, and then we always ask the question, what is unique about this particular project that would indicate that we have additional risks, or some of the risks will not be active in this project? But those are the questions that we would ask. High quality ingredients, uncertainties. So this is the other source of risk in projects, is uncertainties. Uncertainties are modeled with 3-point estimates: low, most likely, and high for cost and schedule. Uncertainties, unlike risks, represent unmanageable variances. As they are unmanageable, they cannot be reduced and therefore can only be accounted for with margin and contingency. As with risk events, your best source of data is your historical records. We highly recommend data mining your project archives to generate statistical distributions that are related to specific task types. These distributions can be modeled using coefficients of the most likely to calculate low and high values. This is often called reference class estimating. If this is not available, then other methods such as expert opinion, brainstorming, etc. can be used, but that would again be less than optimal. We do have some clients who have undergone that, where they've gone back, got as many actuals that they have from previous historical projects, and have gone through this process of creating uncertainty ranges for specific task types that they have on a continuing basis in their projects. So the mixing, we call it. So the first thing we're going to do, now that we have the ingredients, the data, the first step is to import your schedule or create your schedule in Risky Project. Most of our schedules are going to be coming in from third parties. Schedules created in Microsoft Project, XML, or Prima P6 XER, or other scheduling tools that support these formats can be imported into Risky Project. Depending on how you want to manage uncertainties, these can be imported with the schedule or added later in Risky Project. That's a decision that you'll have to make about where you want to manage that data. If you're using reference class estimating, we recommend using the uncertainty bands in Risky Project to calculate and maintain the uncertainties. If you're using expert opinion, it may be easier to manage updates with actuals in the originating scheduling tool. Whichever way you choose, important to remain consistent throughout the process. As we mentioned earlier, once you've got the schedule in, let's run a schedule diagnostics to identify any issues that your schedule might have that will prevent you generating a valid risk assessment. The schedule diagnostics will identify activities that have logic issues such as dangling out of sequence, hard constraints, and excessive floats. These must be resolved before moving forward to the next steps. Adding, importing, and assigning risk. Next, risk can be added or imported from existing Excel risk registers. Once the risks have been added to the integrated risk register, assign them to the tasks or resources that they can impact. Depending on the phase and status of the project, we often recommend running a simulation with risk events earlier in the project to get a better forecast of impacts on cost and schedule that will aid in earlier prioritization and management of your risks. At this stage, it's often sufficient to use a summary level schedule for this first analysis. Once you have a detailed schedule, you can add 3-point estimates to cost and schedule if they are not already in the originating file. The guidance is to use triangular distributions with your 3-point estimates unless you have historical data to suggest otherwise. As consistency is a key to success, we recommend using uncertainty bands to standardize the level of uncertainty in your model. Finally, in cases where the most likely value, the deterministic value, appears to be too pessimistic or optimistic, you can use the most likely field in the risk bands or um, the other dialog boxes where you can add 3-point estimates um, to overwrite the deterministic value. So we can shift what our most likely is in the uncertainties. With that, we should have the data model set up. Next, we want to set up our simulation. So there are a few things we need to consider. One of the outputs of a risk analysis is a risk-adjusted schedule margin or cost contingency. This is set using the high results p-value or confidence level in the project options. Depending upon your risk tolerance, common settings are between p70 and p80. This confidence level for contingency margin should be set as a standard across your organization. So we want to be consistent about how projects and analysis is done across the organization. The number of iterations and the use of convergence monitoring are related. Convergence occurs when the results of analysis do not change statistically significantly over a set number of iterations. When the convergence occurs, the simulation stops and you'll get results. Convergence can be useful when doing what-if types of analysis on large schedules to increase the amount of time required to run the simulation. For reporting purposes, we recommend a minimum of 1,000 iterations and only turn on convergence if the above mentioned circumstances about doing sort of quick what-if analysis um, is what you're attempting to do at that point. So we run the simulation, and now we want to do, when we get our results, we want to do a reality check. Before publishing your results, you've done a lot of effort, but it wouldn't, unless you wouldn't serve without first checking with how it's all turned out. So if it was a meal, it might need a little bit more seasoning or another 15 minutes in the oven. Same can be said of your analysis. In this case, we call it the reality check. Does the ranking of the risks look correct? So are we seeing something that looks out of place? Do the histograms and cumulative probability all fall within reasonable expectation? In the sensitivity chart, are you seeing tasks that you didn't expect to see, or vice versa? If so, your model may need a little updating before the final step. So again, we can run one analysis, and it may be, and I'm not advocating that you sort of game the system to make it look like you want it to, but a lot of times we'll see if the schedule quality isn't um, as good as we'd hoped, you'll find that you've got all these risks, you've put a lot of uncertainty, but we don't see any, the finish times look far too optimistic, and that could be because you have some hard constraints or other schedule logics that's blocking us seeing the full range of outcomes. So those are sort of things that we want to do, is just do a reality check, go over the results. Does it make sense? Does it pass that sort of reality check? Reports. Finally, after all the work, you can get to serve the meal to your guests. Or in this case, you can share your analysis with your team and other stakeholders. These indicators can help improve your team's decisions and ability to manage the project successfully. Mean results for cost and schedule. It could be that you're going to export the results back to your scheduling engine as an XML file at a level, deterministic or a p-value. Could be p50, could be the mean. Uh, And then that becomes the baseline. Risk adjusted cost contingency and schedule margin. And you can pull that out not just at the project level, but at every single activity. We suggest that you pull out costs and they be assessed or added at the uh, milestones or WBS levels, and they can all be pulled out from the reporting. Risk ranking and the cost of risks, so that then you can present that to your risk management team. Crucial activities and or task criticality, again, that gives us some idea about where we have high levels of risk in your schedule, and where you can apply management, where you should focus management attention onto the schedule, just in case any problems can occur, or you can be proactive and address those before they occur. And finally, probabilistic cash flow. How long is the project might run, and what do the costs look like in terms, are you going to be spending like you did, or are you going to need to transfer um, transfer your budgets and reorganize your budgets based on the results of your analysis. So with that, you've gone through, you've used this as the recipe, and you've got your meal, and you've should have a reasonably high quality risk analysis that you can share with your team. I just wanted to finish off with one comment, a couple comments. I call it peering into the future. And just at a conference, and I call this AI is just around the corner. And this is especially relevant for those who are working on large, complex projects. Much of what we discussed today will be augmented by AI. So AI is going to go a long way to solving what I call the garbage in, garbage out problem in terms of schedule quality, in terms of risk drivers and events and how they should be modeled, and the ranges of uncertainty that should be applied. And they're also going to be able to provide, especially on large, very large mega projects, complex projects, I think far better insight into it. It's AI is fast becoming a viable tool to help improve all aspects of the project management, from what I've seen, including the risk analysis and management. I'd say there are already some AI tools on the market. What I think they suffer from is they are a black box, where they don't really provide a lot of insight into how the analysis was performed, and sort of rely on a trust me approach. The best applications that I've seen in development will assist teams through recommendations and provide step-by-step insight into the process. So if you're worried about how this or how we'll do, I have seen some demonstrations of these AI agents, which are able to take a large amount of data, but then pass on not as a black box, but you can actually see what they're saying. They communicate to what issues they found, and then make recommendations to the team about how they can resolve those. I've also seen that they can then take on the back end of the analysis, that they can then provide some really critical insights. And one of the other things is you'll see with the AI coming in is they will be able to do it in a much more timely fashion.